Hello there. I titled this video as End Game. So the end game is not for the course, but for the trading part. I'm hoping that you've tried some of the things that we talked earlier and you've applied it in the how the market works game. So we are going to talk a little bit about the patterns and charts in this video, how to read stock charts, some very basics I'm going to share with you in this video. There are two levels of quotes that you typically find. One is what we call level one quote. So level one quotes are the basic quotes that you get, something like the basic information about a stock. So ticker is just another name for the company. It's a shortened name for your stock. And more time you spend on the market, you get to know certain tickers of the big companies, right? The big and even the small companies that you are interested in. So knowing them would allow you to process your trades faster. And that comes with time. I mean, you don't really have to remember them. Then the time frame of the chart is important, right? Chart could be the chart that you're looking at any point could be telling you a story of 1 minute. It could be telling you a story of an hour, half a day, 1 day, or a week, a month, right? All those. So one particular part of the chart could actually be, condensed. And as a day trader, you want this time frame to be as short as possible, understandably. Then you have the information about the exchange in which the particular stock is trading. And the exchanges do have certain characteristics. So you can't really compare exchanges. And you clearly, by looking at the exchange, you know what kind of depth you can expect in that stock. What do I mean by depth? By depth, I mean how much institutional interest is there in that particular stock. Of course, that depends on the company, the size of the company, but sometimes exchanges tell you a lot because some exchanges have depth, which means there are a lot more investors than the others, and that decides the fate of your trade to begin with, right? And you've got these terms, L, B, A, O with your stock, and that allows you basically to buy and sell. And what is the demand? Bid price is the price that the other side of the trade is willing to pay for. So that's B is your price, your selling price as an investor, right? If you are on a trading account. And ask is the price at which you will be able to buy something, right? So B and A, you should remember. And last, open, these are the price movements, high, low, volume, all these important information that you get from the chart one, level one quotes on the chart. Level two, I'm going to introduce you, and probably some of you will already be aware of it, but that's the coolest thing that we have to understand, especially from the point of view of risk management, to minimize our risk. So something that is very common, and again, it's the candlesticks. Candlesticks are essentially, they tell us all about, just a minute. I don't know why I clicked here, but I was trying to get my pen, but somehow it works quite strangely. I'm not able to get my pen. Anyway, you won't be able to see my cursor, and there should be a way to deal with it. Anyway, so the green one, when you have the candlestick that is green, it tells you that the stock has gone up. And if it's in red, that means the stock prices have gone down, right? So there are four elements, four parts of this candlestick. So the lines on the top and the bottom are called wick, and then the fat body in the middle is called body, understandably, right? So high and low, they are basically the price movement during the day or during an hour, because candlestick could actually, like I said earlier, the time frame, one candlestick could show a minute's trade, it can show 10 minutes trade, 3 minutes, whatever, right? Or even a day's time. One candlestick could show that, right? So high of the day, low of the day, and the close is the price at which the stock opened, and the open is the price at which it opened from when the market started, right? So obviously, in case of profitable trade, the close is going to be higher than the open, and the vice versa in case of a losing trade. So this can be used quite remarkably in understanding market, but this takes practice, a lot of practice. And after a practice, some people are able to predict price movement because yes, these sticks do move in certain patterns, right? And that's where you take advantage. There are two things. One is it's not scientific. What happens when the sticks start to behave in a certain way and market has a certain way to a certain belief about those movements, then it becomes a self-fulfilling prophecy with so many other things, right? Psychology kicks in, everybody starts to play the same way, and you find price moving in a direction that everybody thought it will move. So the candlestick shapes or patterns, they tell us about how the market is feeling. If the market is bullish, that means the stock price would continuously go up, and you'll have the color of this candlestick green. If it's bearish, then the price, there is a lot of pessimism in the market, and the price would continue to go down. Indecisive, you will see bullish, bearish, bullish, bearish. You'll see it happening, yeah. So you will see these patterns revealing the market sentiments. Now let's talk about the level 2 quotes that I'm really excited to share with you. And this tells us about the market depth. Market depth is how much interest is there, how many players are there that are looking at that stock, that particular stock. So at any point of time, when you look at the level 2 quotes, which come in most of the trading platforms, and they look very different depending on which platform you're looking at, but they will have something like this. You will see left and right columns here, right, with the green and red color, and that tells you about the number of buyers that are sitting at the bid price and the ask price, right? So bid price, to just remind you, I just explained a few minutes ago, bid price, the price at which the buyers would buy from you. So that's going to be your selling price, right? And usually these buyers, they are sitting, at what price they want to buy, right? Usually their prices are displayed, how many stocks they want to buy, the volume that they are interested in, that's also displayed in these level 2 quotes. And these buyers are big institutional players called market makers, right? Market makers are the institutions that are tasked with making market and also discover the price of that particular stock or equity or whatever, right? So you can find stocks that are very thick. As you see here, thick market means there is a lot of institutional interest. There are a lot of market makers that are interested in that particular stock. If it's a thin market, that means there won't be so many. The list would be slightly smaller. So most of these players that you see on this chart on the right side of your screen, these are big institutional market makers. You can see Bank of America. There is also NASDAQ. There is UBS and some other players, big players. These are all big players, right? So what can you use it for? If you can see that, most of the time these bid prices by these market makers is right below the current price, actually. So they are sitting and they're hoping to make some money below the current trading price. And that allows you to look at your downside. If the stock starts to go down, you know how quickly you can get out, depending on numbers of buyers that you can see, right? If you find the number of buyers is very thin, that is a problem in your exit plan, right? So it's a risk management thing that you can all the time look, and especially if you're doing day trading, your exit is as important as your entry, right? And by exit, I mean exit, I place more emphasis on the downside when you're looking at exit, and that allows you to minimize your risks, right? So the thicker the market is, you get the exit that you want, right? So that's an extremely, extremely important part of day trading, understanding these quotes. Then we also want to look at the pattern trading. So pattern trading, I mentioned there are probably hundreds of thousands of patterns that come regularly in front of you on the screen. They appear. And more you practice, and that's why I've said it all along this course, that you have to practice these things. You have to practice them for months before you put your real money, right? So patterns you will start to see, and really it differs from person to person how good you are at recognizing or identifying these patterns. It differs, really it differs. And some people, after they spend some time, they start to look through almost like, matrix. So some of these patterns could be technical. There are, again, thousands of technical indicators that you could try to find a pattern out of. Then there are fundamental catalysts like an M&A that a company is typically driving in that industry and what it does to the price, right? You have a certain sense of it that you've seen before. A fundamental catalyst, and then there is a fixed strategy which is not dependent on either a big technical blowout or a fundamental catalyst changing, but you say that in this company, in this stock, I'm going to do this with the price hitting here, 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 right? So you've got certain things. It's a very, very fast game, right? You have to move very quickly. You have to get in very quickly, get out very quickly if you want to play the scalping game. And what matters really is the profit loss ratio. And if you looking at the number of trades that are profitable versus number of trades that you are making loss, it could be even 50-50 and still you'll make profit, because by practicing a lot, you figure out you become perceptible in picking out the red flags. And the moment you see even a few red flags, I'm speaking from the experience, you take smaller bets. And there are moments when you find this free hit, potential for a free hit, and you go all in, right? You put a larger bet. And my experience is, even if you have a profit and loss ratio of 50-50 in terms of the number of trades that have gone south and north, still, if you have developed that sense of understanding about the risks and what then happens, even with the similar number of transactions that have gone successful and failed, you would be able to make more money because you put higher bet on the profitable trade or seemingly profitable trade, right? This is how always works. And that's where the discipline kicks in, right? You place certain tick boxes. If you find them all in your scheme of things, in your strategy, then you go with a bigger bet, right? The important thing, and I've said that earlier also, the high frequency trade or algorithmic play, these are the stocks that are big. Having said that, if you looked recently, a company like Tesla is behaving like a small, really penny stock, right? The 17% price movement on a day, that is quite phenomenal. Now, this is a very different company than the rest of the company, the amount of volatility that it brings in. So by all means, I'm not against people betting, using their money and bet with Tesla. It's a company that's yet to settle. It is highly frothy if you look at the fundamentals, but who cares about fundamental? As I said earlier, right? It's all about you being comfortable in the moment and you being comfortable with what you see from the demand side, right? Which is to say what the other traders are thinking at the moment. And if that is all positive, then you don't really care about the fundamental. And that's another play that, so typically I would say pattern trading, you don't want to go with the high frequency trade, which means the computers that are running these automated transactions for big institutions. You don't want to go against them. So the focus is always on the retail stocks. Retail stocks, because it's easier to analyze and it's difficult for some of these machines to really take into account for two reasons. One is those opportunities are too small for these big institutional players. Number two is also these stocks have an emotional side to it. And I think the AI part is still not there. Maybe in a couple of years, the AI would be able to understand and decipher. There are a lot of apps that are actually now tracking the sentiments and emotions of the retail market. Retail investors like you and I, right? Individuals, And so more and more machines get better with that analysis, then you'll find probably we are losing out on a lot of our bets, right? But right now there is a big niche that exists for retail investors to make profitable trades. Now, these are stocks that are driven primarily by catalyst that can be qualitatively analyzed, not quantitatively, right? Because emotions that's going around is not based on the fundamentals, it's not based on the financial performance or the accounting books of the company, but simply because there are a number of people who believe or who have this activist bent and they want to go against the big institutional play, what we see with the meme stocks and all that, right? So again, there are some interesting phenomena that's happening at the moment. We want to take that into account. And now what I want to do as a day trader, you want to keep your candlestick at the lowest possible time frame, because you want to see any change within that 1 minute frame. 2 minutes is my go-to candlestick, but 1 minute is could actually have too much information. So it depends how much information you can process. And initially, I think 1 to 5 minutes, you can figure that out, the one that you're comfortable with. And remember that from 1 to 5 minutes, there's going to be different patterns again. So once you decide this is going to be my time frame, you stick with it, because then you will see what kind of pattern it leads to. Because the longer the time frame, the patterns would be very different. For instance, if you're taking 30 minutes candlestick, then you'll see very different time patterns. So I'm not really going through the entire library of what the patterns would look like, but I mean, these two are quite common. And there are, again, like I said, there are thousands of patterns, but you'll see them emerge again and again. So this is from 1 to 2 minutes time frame. You will see these flags appearing on and on. What it means is typically what I'll do is when I see these, it's fairly green market to begin with. And these three candlesticks that you see going up, the second candlestick, typically I place my bets on. And but there have to be catalysts behind it, right? So you check your catalyst, you see what's happening, you look at the level 2 quotes, and then you go with these. Staircase is another example where you know the overall story or the market sentiments are pretty positive, and then you see, okay, there is a slight correction, and then it goes up, and then there's slight correction, and these happening in real time in a few minutes time, right? That's what you're getting yourself comfortable with. So acclimatizing yourself to all these price movements and figuring out that, oh, this is a pattern I see so often. You will actually find, I think, at least a dozen price patterns if you spend a month looking at these price charts and candlesticks. And that's the beautiful part, right? So you can't have, I mean, I can't really give you 100 different patterns, but I'm just telling you, you will start to see them again and again. And then you'll realize that, okay, they help you discover your entry point, because you know, yes, I know, I am 90% sure it's going to go up in the next few seconds, right? And that's when you enter, right? Anytime that's the kind of confidence that you want. Depends on the trade, but my usual trade lasts about 15 seconds, right? That's the maximum that I'll be staying with that. And I'm looking for that upside of 10%, 20%, whatever, right? I make based on the indicators that I put in together. I decide what my profit for the day is going to be, but it's never too much, right? Even though you find the whole market screaming, this stock is a buy, even then you stick with whatever you've decided as your exit point in the profit. But if you're losing money, and that should be again driven by if you find a few red flags, which invariably are always there. Anytime there is a loss, and that's why it really helps to have some kind of a system by which you can revisit your trades, right? You want to revisit them. It's a lot of work, I know, but it allows you to understand your weaknesses and how your reaction was late, what was the indicators that you were looking, and what you could basically, you couldn't notice, right? So checking those, going back and checking those points helps you to minimize your risk in the real market, right? So it's important to know the pattern trading, it doesn't work on all stocks. It definitely works with the stocks that are not part of big institutional plays, because big institutional plays, the places where big investors are putting their money, big trading companies are putting their money, which is the high frequency trade, those stocks are not going to be affected by patterns because the patterns would be broken again and again, right? Because a lot of it is driven by machines, remember, right? And the machines are looking at patterns very differently than we, because they are, taking in so much data at the same time, which humanly is not possible. Then all of these companies that would, where pattern would make sense would be the ones liked by retail investors like you and I. And these companies tend to have high relative volume. And like I said, it's a self-fulfilling prophecy, which means if the whole market believes in stock moving a certain direction with certain pattern characteristics, then it's more likely to happen. And so you want more and more traders to be on your side. That's how you play it, right? You don't want to be alone in this. So you don't want to be contrarian, and that's why the contrarian trader doesn't exist. You survive as a trader by being in conformity to the rest of the market, and at the same time, you stay a few steps ahead of the others, right? Everybody is in the same race, and you want to be a little bit ahead so that you enter at the right time and you exit at the right time. You don't want to hold the bag right at the end of the day. That's all about the charts. I want to have, I want to know, I want to do a real time session in the next week because just to figure out what you've done with how the market works. If there are problems, if there are some suggestions, sharing your winning ideas, we want to do that. So a real-time session sometime in the coming week. So I put together a sheet on the Hoppy. So if you go to the Hoppy, I send you this announcement, which is about the sign up sheet. So it's a Google Doc. And if you go to this Google Doc, this is how it looks like. So please write down your name here. I want your name, and I've got 3 time slots. One is on Thursday, Friday, and Saturday. 3 time slots for both Thursday and Friday. I understand their classes. I got them early morning, 8:10 to 9:10. And on Saturday, I'm much more flexible. So from 9 to, whatever time it is fine with you guys. So what I want to get is I want to get maximum of you signing up for it. The participation key, if you click on the participation key, it tells you 3 keys that you can put in. You can put Y, which will tell me that you can attend. N is you are unable to attend because of other classes. And NS is you are unable to attend due to some personal reasons. Or it could be technical as well, right? So these are 3 keys that you should put some, on these slots, whichever works for you. Please do that as soon as possible so I can plan it. And we're gonna do a Zoom session in one of these 3 time slots that's there. And I'm hoping to talk to you before we go further into, before we go further with this course. I want to do the next week in the next video, not next week, next video we will be trying a deep or shallow dive depending on the feedback I get. It's going to be about technical analysis. We'll pick a few technical indicators. We'll try to dissect them, understand the usefulness of them. So that's with technical analysis, we will actually shift into the investment mode, right? From trading to investment. Whatever you see in this video, that's basically where the trading, specifically information about the trading ends today. Technical analysis is more generic. It could be used in trading as well as investment. And then we will, from the next video onwards, we will be fully focusing on the technical, and then thereafter we'll go into the fundamental analysis and how some of the big factors and big indicators that we rely on to make investment, and how that whole experience and philosophy of an investor is totally different than what a trader would be. You already understand that. So that's going to be roughly the content of the next video. Please keep on playing the game. Please also keep on posting your news. I'm going to see you in my next video. And hopefully before that, I'm going to see you all in the real-time session sometime in the coming week. Take care. Bye-bye.